heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York. Ed Ludlow, who's off today. This is Bloomberg Technology. The UK's antitrust watchdog. It strikes again, this time with an investigation into Amazon and Microsoft's cloud services. Details on yet more concerns that US tech giants could be abusing market power. Plus, it is day 2 in the historic FTX fraud trial, a look into the crypto hedge fund Alameda Research and Caroline Ellison's role. And this hour, we have an exclusive conversation with San Francisco Fed President Mary Daly from the Economics Club of New York. You do not want to miss it. But first, let's check in on these markets, because it is about the macro, it is about the Federal Reserve, about Mary Daly's of this world that is currently affecting the market. The macro picture being that the jobs data still looking strong. We see some sell-off in the Nasdaq 100 as the all-eye tomorrow. The important non-farm payrolls data coming after the jobless claims today still showed that resilience of 5 percentage point. 2-year yield actually, though, recovering somewhat. Stabilization, shall we call it, in the bond market, but we're still above a 5 percentage point level. What sort of appetite is there for these riskier assets when we have such high yields? We're seeing Bitcoin just off about 0.3%, the dollar stabilizing today. Let's look at some of the individual movers. When you're looking at the micro data, I'm looking at Micron. It's coming up by 0.6%, or maybe that's because Samsung Electronics managing to boost the price of their own memory chips. A read across to some of the other players there. Airbnb, though, on the downside once again, really getting some of these sell-side analysts saying, look, we're downgrading this stock. This time it was Wells Fargo in terms of a price target. We're looking at Amazon also off by 1.4%. Interesting. This is as it's being eyed in the CMA by the UK in terms of its, monopolization they are potentially worried about of the cloud market. Remember, the FTC analyzing Amazon here in the United States about its marketplace. And of course, this is all in this atmosphere of more regulation coming towards some of these big tech companies and the worry of the prominence they have. Let's just stick on that particular role of Amazon right now. I want to bring in Bloomberg's Thomas Seal for more. And that the CMA is once again trying to show its chops here. They did it with Microsoft and Activision Blizzard, and now they're analyzing Amazon and Microsoft in this case.
That's right. It's the next one in the series, and Microsoft again in the spotlight for another cloud concern. Microsoft and Amazon between them occupy about 70 to 80% of the British cloud computing and storage market, Ofcom found after it's been looking at this for a year, and it's decided there are concerns, and it's given this to the antitrust watchdog, the CMA, which kicks off a huge process again. Amazon
itself has come back and said, you're misreading our data. But ultimately, what is the argument of Ofcom? What are they seeing in terms of pricing power that these two players have?
Yeah, they really outlined 3 concerns in the big Ofcom study. One of them is this thing called egress fees, basically exit fees. If you try to take your data out of the cloud, you get charged, especially if it's a big amount of data, and more people are doing this. This is something that could lock you in. This is what Ofcom is kind of worrying about. Another thing is interoperability. Lots of big companies want to run more than one cloud, different clouds for different things. That's technically difficult. And the final thing is discounting for big committed spend. This could incentivize keeping all of your eggs in one basket, and that's not very competitive. That's another worry that Ofcom outlined.
Amazon has come back and said, look, we disagree with Ofcom's findings. Quite bluntly, they say they're based on a fundamental misconception of how the IT sector functions and the services and discounts that they offer. Remind us, Thomas, this is really expensive to be an offerer of cloud. You have to almost be a huge player. How hard is it to have fundamentally a lot of smaller players within this?
Yeah, I think Amazon and Microsoft didn't fall into this. They've really built the backbone of the internet, massive data centers, warehouses, subsea cables, increasingly edge data centers, which are close to cities, so that you get that snappy 5G internet that everyone's going to be increasingly needing. So, they have put a lot of work into maintaining and building this position, but Ofcom and now the CMA are going to be looking into, well, can anyone else get into this? Is this going to impact on the kinds of services that we have in the future? And are there potential concerns for what this means for AI, which is going to, people think use even more cloud computing than we use today?
Ultimately, we're interested also in just the UK vis-a-vis the US, vis-a-vis Germany too. I mean, the EU has also been looking into competition within the cloud space. How much is that something that some of the big tech companies are having to navigate?
I'm really sorry there, I've lost you. I think you were asking about international comparisons.
Yes, let's look at Germany for a moment.
Yes, I mean, it's an interesting one for the CMA because post-Brexit it's sort of out there alone, whereas before it was part of Europe. Ofcom's report does note what's going on in other parts of the world, so notes the FTC looking at this, the EU looking at this, and ultimately maybe the CMA becomes more of a sideshow as these much bigger regulatory regimes hone in on this same market. And
also start to think not just about the impact from work perspective, social media perspective, but now, of course, generative AI and foundational model perspective. Thomas Seal, great to have some time with you. Thank you for laying it out when it comes to Amazon. Now, let's get back to antitrust here in the US, because Google's trial, it's still underway. And in transcripts unsealed by the judge last night, we learned that Apple actually held talks with DuckGo to replace Google as the default search engine for the private mode on Apple's Safari browser. Ultimately, they rejected the idea. Bloomberg's Sarah Forden now joins us from Washington, and yet more sort of detail coming out here of just how much Apple had analyzed other competitive search offerings out there.
Yes, and exactly. The unsealing of this testimony last night was really quite extraordinary and a very important part of this case. In fact, the judge himself said that he read through the testimony, which had been taken in a sealed courtroom. He read through it line by line and felt that what is being said here by these executives really cuts to the heart of the case against Google. And this has to do with Google's $12 billion agreement with Apple that allows it to be the default search engine on all Apple iPhones and other desktops. So it gives them access to a tremendous amount of data. And we know that data and building scale for a search engine is actually key to sort of keeping those search results high end and quality and dominating the market.
I mean, the level of detail, as you say, is extraordinary. DuckGo CEO testifying that he met with Apple 20 meetings and phone calls with various Apple executives, including the head of Safari. Does this, though, ultimately paint a picture that, yes, they didn't find a better offering out there than what Google currently serves to the market? They're not favorizing Google because of the money. It's just that it's a better search product for the consumer.
Well, that is true. And in fact, there was testimony from the Apple executive who negotiated the deal with Google, John Andrea, and he said ultimately they didn't go for an alternative. He also revealed there had been talks with Bing as well in 2018, 2019. But they ultimately decided that Google was the best. So certainly that's a business case, but I think this testimony is going to be very critical in terms of how the judge ultimately decides about the market issues and the dominance issues. And this is not a jury trial, so the judge will be the one to decide this case.
And it is, of course, earlier this week that the judge heard from Satya Nadella, the CEO of Microsoft, who was trying to be out there building Bing as a competitor. And it's in this moment, though, that we feel that there is some competition potentially coming from a Bing with the partnership that they have with OpenAI, certainly as search perhaps pivots in this generative AI world. From all the testimony thus far, is there any read that you're getting as to which direction the judge might end up landing here?
I mean, it's still too soon to say, but certainly the government is putting on the best case that it can. This is a test case in every way. This has never been done before. And this afternoon, actually, the expert witness for the Justice Department is going to be testifying about market definition. And so that's going to be key information that the judge is going to need in order to make this decision.
We'll keep abreast of it with your help, Sarah Forden. Thank you very much indeed. All things regulation at the top of this show. Meanwhile, coming up, we're going to be looking at another trial, but this one, a fraud one. Sam Bankman-Fried, the disgraced 31-year-old, preparing to convince a jury that his crypto empire wasn't a fraud. And let's take a look quickly at shares. As we go to break, there's plenty of things on the move when you look at the micro detail today. So apart from the macro jobs data, we're looking at individual companies that are currently on the downside. On a day of sell-off, Rivian absolutely tumbling. We saw it down by as much as 19%. This is the company, electric vehicle company. It's actually looking to sell convertible debt. What does that mean? Well, it could end up boosting the supply of shares out there. So we're seeing a depressing force on the stock. We're off by some 20%, let's call it. $19 is where we trade. And also looking at Lucid Group. Now, interestingly, this could be falling in sympathy, but also the EV maker actually offering a new, perhaps cheaper model. Investors may be reading the worry about whether that's really a price cut in this current environment. It's down some 9%, one of the worst performers on the NASDAQ 100 today. This is Bloomberg Technology. We've got to get you up to speed with the latest on the trial of former FTX head Sam Bankman-Fried. Pleased to say, not at the courthouse, but here in the New York studio is Sonali Basak, but really keeping the context broad here of now who else is going to be giving evidence and what shocking revelations we could hear from it.
Yeah, and I must say, it's interesting. I love being on set next to you, but that courthouse right now is just also fascinating. You have the witnesses one by one starting to come up, including a developer at FTX who has been speaking about his long friendship with Sam Bankman-Fried since MIT, as well as what he was told while he was working at the company and the safety and security of the firm while he was there. More interestingly, you have Gary Wang, who is the former technology officer, co-founder of FTX, expected to testify as early as today. Remember, Gary Wang was one of the people who had pled guilty and is a cooperating witness for the trial, one of three very important key figures from the very inner workings of FTX. As we know, the prosecution has drawn out that really there were only a few people that knew the extent to which this fraud was carried out.
And one of the key people is Caroline Ellison, who of course was heading up Alameda Research, which ultimately was attested to be sharing and commingling funds from an early day.
The Caroline Ellison part of this is just becoming more and more pronounced as this trial goes on. She was brought up both in the prosecution's opening arguments as well as the defense. For the prosecution, remember that inner circle I was talking about, they were talking about bringing her to the fore along with some of the other co-founders for them to explain their interactions with Sam Bankman-Fried alongside the evidence that will be presented. The prosecution really defines two ways that Alameda had taken money through FTX by means of both cash as well as through its digital wallets. So they will be using Caroline Ellison to show how that exactly had happened and when and what Sam Bankman-Fried knew and what he had actually directed. Now, in the defense part of the argument, they have said that Caroline Ellison was the one that was running Alameda. They had made the case in the defense that one person cannot be, not one person, not one CEO can be at all places at all times. And as a shareholder of Alameda, had directed Caroline Ellison to do things like hedge the portfolio ahead of the crash that had led to the ultimate bankruptcy of FTX, despite the alleged commingling of the funds. So remember, this was Sam Bankman-Fried's former girlfriend we are talking about, who had a lot of details about how Sam operated himself. It will be up to the jury to decide whether that defense will be sufficient enough to really pin a lot of the blame not just on Sam, but his colleagues who have already pled guilty, by the way.
Fascinating. Thanks for keeping us up to speed on it. Sonali Basak there with all things FTX. But well, let's go macro now. Let's go to the Economic Club of New York, where I'm pleased to say our own Lisa Abramowitz is sitting down, none other than the San Francisco Fed President, Mary Daly. Listen in.
The Fed doesn't need to hike again.
Again, I'm going to remind everybody my views are my own, and I don't speak for anyone on the committee. But that's exactly how I think about it. So just instead of that, let's go back to the June SEP. where, if you remember, or maybe you don't, I'll remind, in the June Summary of Economic Projections, there were 2 more rate hikes projected for this year. Then in July, we took one of those rate hikes, and another one in the September SEP was the median outlook. But the bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there. So from my own perspective, that's what I look at. You know, that my job as I see it, our job as I see it, is not to tighten, just do our part. It's to watch financial conditions, because monetary policy works. We raise the funds rate, and it moves through all the other interest rates. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Yeah,
Does that make sense?
Absolutely. And Rich Clarida said today that the rise in yields actually does the Fed's job for it. Would you agree with that? Would you sympathize with that kind of sentiment?
That is actually how it works, right? If financial conditions tighten, I mean, one of the things that's happened in the last 90 days and certainly in the last few weeks is that financial markets have collectively seemed to take on board a variety of things. But one of the things that I heard from many commentators and many of the market outreach I do is that they have a general understanding now that we are committed at the FOMC to keeping rates higher for longer in an effort to bring inflation fully back down to 2%. And that recognition, along with all the other factors we could put in a list about why bond yields have risen, are affecting certainly the financial conditions and the tightening. And I see that as a positive outcome, that we would have tighter financial conditions, because then we can really get the job done of putting inflation back to rest.
When is a sell-off something that's welcome from a perspective of finally the market is coming to terms with what the Fed has been saying? And when is it disorderly, disruptive, on a level that causes concern?
So you always want an orderly repricing over a disorderly repricing. And so far what I see is this, you know, and this is why we watch it so carefully, but here's how I'm seeing it, is that what's happening is financial markets are actually trying to find their footing and the right price for things, and they've got to digest a lot of information. One is the supply and demand changes in the Treasury space, right? So supply is going up and demand is going down, especially from foreign buyers. So that is one factor to digest. Another factor to digest is Fed policy and forward guidance in the SEP. A third factor to digest is this increasing conversation people are having about whether the real neutral rate of interest is actually risen. So we came into the pandemic with it at about 0.5, which means nominal neutral about 2.5. And when people say, oh, the neutral rate might have risen for a variety of factors, I'm hearing everything from maybe it's 5 to something that I would see more likely, which is between 2.5 and 3 for the nominal neutral. You know, probably we don't know if it's risen, frankly. I don't think anybody really knows, but certainly we should have those conversations. But then markets try to price that in. So all of those factors, and then there's lots of uncertainty in the economy and geopolitical risk and, you know, our own fiscal risk. And so that's what markets do. They digest a lot of information and try to find their footing on it, and I think that's what we're seeing. But so far, it hasn't spilled over into disorderly. So far, even today, when the jobs claims came up, and it was sort of, I don't know what to make of it, right? So that's what the markets sort of read it. You didn't see things shaking up in a wild or disorderly fashion. So far, so good.
Your bond quote of the day, 470 on the 10-year, I just checked. So it seems like yields are coming in as we speak, to your point about it not being disorderly. Back in March, when there was this concern about the banking situation, yields were at the low of March, were about 150 basis points lower than where they are now. Are you seeing the same type of financial distress today that you did back then, even on the peripheries? How do you rationalize why it hasn't materialized in the same kind of way?
So March was a unique situation, and we want to learn from that unique situation. But it was a unique situation in this way. We had a bank run, a very old-fashioned but true bank run, where the bank's liquidity was completely squeezed, and it dissolved in a period that was it was short, rapid period of dissolution. And then that spilled over to 2 other banks. And that was the extent. Now, one of the things I always remind people of is we have over 4,000 banks in the country, and 3 failed. And all other banks that even felt the stresses, and there were a large number that felt stresses because they were near neighbors in sort of size and balance sheet, distribution, composition. They felt stresses, but they managed those stresses because in part they had been a little more effective at hedging their risks, and then the Fed and with the Treasury support came in with the BTFP, and that produced a lot of calmness in the water. So since that time, banking stresses have really not been something that when you ask people in the community or the business leaders, what is top of your worries, that is not something they list. They list inflation, uncertainty, et cetera. So I think one of the reasons that we are seeing this yield rising not spilling back over is that essentially, we know what's going on in the banking sector. Investor letters have been published for months saying, here's what this balance sheet looks like, here's what this balance sheet looks like, so there's not a surprise. And the second is because the banking system is safe, sound, and resilient, and we have remedies in place that solved parts of the crisis and the stresses. So I think we're coming in, it's the same thing when you have the rise in yields, we're doing it against a strong economy. We're doing it against a strong, a solid banking system. So that just means that the ripple effects are not going to be tipping things over. The fragility is not there, right? It's a sound system, and then you have this, and so then you have it able to absorb the tension points.
One thing that there's been a huge debate around is the long and variable lags. And this really speaks to this question of all of a sudden, if you think that 10-year yields are at 5% rather than 4% or 3.5%, that changes what implication there is into different business models. How much does it change the business model of commercial real estate owners, of different residential real estate owners, of some of the constituents who you speak to on a regular basis?
So I'm going to separate, that's a terrific question, but I'm going to unpack it into two parts if you don't
Please.
mind. The long and variable lags and the how are people reacting to that? And I just met with a variety of commercial real estate CEOs with national footprints on Monday, so I can bring some of that to this conversation. But let me start with the long and variable lags part. So definitely, there's always a debate. If you want to really get into debate, get a PhD in economics, and you'll spend a lot of time if you're in macro debating long and variable lags of monetary policy. So here's what we can all agree on. There are lags, and they're variable. And then people even debate about long, how long are they? But I go with long and variable lags. And the question is, we know that from the Fed's communications to financial markets went quickly. And then the question is, how long does it take to get through the economy? I'm of the view that we're still seeing the effects of that. We saw it initially in housing, then we started seeing it in investment. Now we're starting to see it in the labor market and inflation, et cetera. And so it's absolutely happening. And we want to continue to watch that because we're with the risk more balanced on the economy. We could as easily, I think at this point, overcorrect than undercorrect. And that's why taking the time to do it right is sort of where I think we need to be. Now, on what I'm hearing in this rise in yields, they're less concerned about, they have been less concerned, at least my commercial real estate roundtable, less concerned about the lags in monetary policy as much as this. There is this time when people were in, one person described it as sort of it's almost like a foot race, right? But it's not really, it's really just like I have to see if the Fed will cut rates before I have to refinance my properties. And so you're in a look ahead and you're saying, well, if the Fed cuts rates like the market suggests they will, market suggested 6 months ago, early in 2024, or at least by the middle of 2024, then by the time I refinance, I'm golden. But that equation changes if we're higher for longer to get inflation down, or if the yields are just going to be higher, well, then projects that penciled out at near zero interest rates or something much lower, they don't pencil out at 5. And so I think one of the things that we think a lot about is what's the switch point for commercial real estate? Because you really want that to be an orderly repricing, and so far it has been, rather than a disorderly one. But I think that's a risk worth watching, is that these higher yields change the psychology of what's possible for people, and they start making those adjustments immediately, as opposed to in a timeline that goes with the refi schedule.
Just to build on that, this idea of 5% or 4.8 or 4.7% of long-term rates that's being increasingly priced into markets, how much does that imply a significantly greater degree of distress in some of these areas like real estate, commercial real estate, that rely on this idea of refinancing 5, 10 years down the line?
You know, I think we have to, and this is one of the things we're going to have to do just as a nation, is if we're in a higher interest rate environment in general, and I don't think we should jump to the conclusion that that's where we are. I think we should have a conversation. Is it going to be the low interest rate environment? Are we going to have a nominal neutral of 2.5, or is it going to be something higher? Are we going to be fighting inflation from above our target now for a persistent amount of time, or is it going to go back to fighting it from below our target? We don't know the answers yet. So I think what was really important is commercial real estate owners and purchasers and things, they have to be willing to play the longer game, right? What's the longer game look like, and how do I get to the longer game? And I'm hearing this in the San Francisco CEO roundtable. Now, again, these folks have a national footprint, but I'll share what I learned is that, they're already tranching their properties. If you've got really high quality stuff, you're putting all your work in terms of leasing into that property, and there are deals to be had. So people with income to use, they're buying those properties up because property ultimately in buildings are valuable down the road. If you have property that you think isn't just in the world of higher interest rates and lower in-office work, then you just say, well, okay, I'm going to go back to land value. And I'm going to not try to spend a lot of time leasing that property or wait it out and I think that's the repricing we're going to need to see. We are just going to need to digest some of those losses and position for the new world. The yields going up, I think it doesn't change that dynamic. It just brings people's awareness sharply to the problem, right? You could have seen the problem coming, and I think many did, which is why I'm not, I don't have alarm bells ringing. Commercial real estate people, they just tell me this all the time, and I have learned to believe them. You really have to have a strong constitution to be in commercial real estate because it goes through cycles. And the way that the successful ones persist is they recognize that the down point isn't forever, nor is the high point. So they get used to it and they stockpile and they refi early. When they see interest rates going up, they're trying to put stuff into longer maturity so that they can not have to refi at the higher interest rates right away. So I think that's going on, but that is a sector to watch, as all of us know. And this will be just another piece. The higher bond yields will be another piece that makes the scrutiny have to be more intense.
To connect that to the idea of financial distress, people talk about a Fed put. How high is the bar for the Fed put? How high is the bar for financial distress? For the Federal Reserve to come in and to cut rates and to take actions to add liquidity to the system? How much higher is the bar at a time where inflation is still running at the levels that it's running?
So I'm going to separate these two things. I think they get pushed together all the time in a way that I don't think about them, so I want to separate them. So there's monetary policy that's about the two goals that Congress gave us, full employment, price stability. And we raise and lower the funds rate to do that work. And because this all gets conflated more easily because we have a balance sheet policy. So we use the asset purchases for two functions, market dysfunction and quantitative easing, right? To put additional policy accommodation in when we hit the ZLB. So we have both, but they can actually persist separately. So let's take the BTFP. The BTFP didn't change monetary policy. We went in, we saw some stress in the banking sector with the backstop from the Treasury, opened the BTFP facility, helped calm the banking stresses, and monetary policy went on. And I think that's the way you should think about it. So I unpack those things. I hear a lot about the Fed put and this. What I really would do is we have tools that can be used, and the tools we use for financial dislocation are different than the tools we use for monetary policy, and both can occur. So we shouldn't have to give up our promise to the American people, our commitment to achieve our mandated goals and bring inflation back down to price stability because we have some dysfunction in the markets. But I, right now, don't see dysfunction. What I see is prices have gone up for bond yield, prices have gone down, yields have gone up for bonds. The 10-year now and other rates look similar to what we might have penciled in the SEP for how much we were going to hold rates higher for longer because of the inflation. And I think they'll respond as the data come in I think markets have a better sense now, although I can't be sure of this. I don't want to I don't want to say things that I don't have certainty about, but it seems there's a more of an understanding about the Fed's reaction function now. And big part of the reaction function understanding that seemed to be missing was that we want to get inflation down to 2%. And in our forecast, we don't see it coming down to 2% like that. And in order to keep it coming down to 2%, we have to keep rates restrictive in order to bring the economy more into balance, the labor market into balance, and inflation down to 2.
You talked about vigilance and you talked about agility. And with respect to agility, you wanted to be able to tweak policy according to what you're seeing in markets. And one thing that people have been speculating, and I'm sure this is sort of one of these theoreticals that make you roll your eyes, like goodness.
I never roll my eyes.
Well, I will say, when people talk about what you said in your speech, which is that as inflation falls and as growth slows, that the policy rate, even by not moving, by keeping it steady, is a policy action. It is actually tightening policy. At that point, how agile should the Fed be to make adjustments to the rate so that the restrictive level is the same, that might be lowering rates, but not because of financial distress, not because of some sort of recession, not because of weakness?
So that's a terrific question. And I would argue that we're now entering into the hardest phases of policymaking, right? The hardest part. So I think of phase one is the one we completed. We completed it earlier this year. Rates are too low, inflation's too high. There's only one direction, north. So everybody can agree, nobody's confused. It's just a matter of how quickly can you get to restrictive territory and without causing any concerning disruptions. So we've accomplished that, phase one. Phase one was the easy phase. You just have to communicate, we're going that way, inflation will come down. The biggest concern that I had during that phase one, well, I had two, how fast can we go without, distressing things? And two, how will we communicate that we're doing that, right? Those were the two things I was worried about. How fast can we go, and how can we communicate that so that we don't lose credibility, right? So because I was worried about the inflation expectation. So that's down. Phase two is fine-tuning where we maintain the peak rate, and then phase three is trying to bring it down to 2%. And so right now, the way it's penciled in the SEP, if the inflation forecast holds, and the inflation forecast you see more generally, policy is growing more restrictive. So you might ask, well, why? Well, I think it's because it's challenging to get that super core inflation down. We've got the easy ones behind us, right? Goods inflation's already come down a lot. Housing inflation is in train. We have to keep watching it. But that super core is going to need persistent work. But if we saw, and the labor market's strong, we're doing this against a very strong labor market. We'll see tomorrow if that persists. But so far, pretty strong, solid labor market, good consumer spending, good GDP growth. I mean, there's nothing about the economy that's faltering. So, but if that should change, well, then of course we could adjust rates so that we keep a level of restriction right for the economy we have. I don't really want to try to tell you what that's going to be, because honestly, that's what the whole speech is about. We have to tolerate our uncertainty of not knowing what it's going to do next year, but to know what elements we have and how would we react to whatever situation unfolds. That's ultimately, humans hate this and markets hate it more. Nobody likes uncertainty, right? They want to know, we all want to know exactly what's going to happen. But I think right now, projecting too confidently what will happen is actually a policy mistake, because then you end up with surprising people and things. So I think it's really important that we stick to conveying our reaction function, conveying how we trade off and balance things, how we approach the uncertainties, and then as we get more information, as everybody does, then we'll of course see what to do next.
With respect to the actual economy and what's going on and what you see going on there, you talk about the labor market and how strong the labor market is, and I know you've done an incredible amount of research in economic inequality and the worker and the labor market. Through that lens, how do you view some of the labor strikes? What's going on in Detroit? What's going on with respect to the Kaiser Health systems? What's going on with just the Hollywood strikes, which are sort of resolved, but maybe not?
So I think, the picture of the labor market is broader than just the strikes. I think the strikes get a lot of, because they're big labor actions, but in general, we've seen a rebalancing of the labor relationships with firms. That is a very common occurrence in an extremely tight labor market, right? Their demand for workers is outstripped supply of workers. That means that workers would have more power to say, I want to live here, do this, have this other thing. So workers who aren't in unions and don't have regularly scheduled negotiated contracts, well, they can make those adjustments more continuously, right? So a lot, I'm sure you've experienced this too, but if you were an employer in 22 and even late 21, and you really saw wage demands rise, special circumstances, I want to live in here and work in there, and I don't want to come back to the office. A lot of changes in how workers were relating to their employers. And there was also a relative demand shock for low wage workers that, you know, moved restaurant workers and hotel workers to delivery drivers and other things. So that whole work situation was changed. I see the labor actions that have been taken recently is they're on regularly negotiated contract schedules, and those schedules came up and they say, well, a lot's changed since we negotiated the last contract. Pandemic, wage rates have risen. We have not been in continuous negotiations with you, and we want to get in a better negotiation with you to ensure that we have some shared responsibility for the rapidly rising inflation and rapidly rising changes in the contours of the labor market. So I think so to answer your question, I think this is completely predictable given the imbalance we've had between demand and supply for workers. And there are going to be some renegotiations either in continuous space, like we have been seeing, or when contracts become up for negotiation, you have to renegotiate the terms of employment.
What's the difference between renegotiating the terms of your employment and a wage price spiral?
Oh, that's a huge difference. So I love that kind of question. Fantastic. Okay, so
sit up straight.
Labor renegotiations are, I'm looking at, you know, what I've had to put up, what I've had to deal with as an employee. A lot of it is, I've got this wage and inflation's going up this, so my real wage is falling. That's something that was commonly happening in 22 in the United States. Real wages were falling for many, many groups of workers, many tiers of wages. And that's something workers recognize, right? They recognize when their real wages are falling. They're losing purchasing power, they're falling behind even though they're earning. So that is what a labor negotiation is. It also could be like in healthcare and things, hours worked, terms of trade, you know, schedules, etc. A wage price spiral is that people get wage growth and then firms selling pass that along to consumers. That causes inflation to go up, and then they see that inflation and they ask for wage growth, and you see this high correlation. A fact that's worth looking at, it's a very cool plot because it tells you why we're not in a wage price spiral right now, is prior to 85, the correlation between wage growth and price growth was like 0.85. That broke down after the Volcker disinflation, and it really is now like 0.25, 0.3, etc. So you don't have that one-for-one pass-through of wages to prices, prices to wages. It just doesn't work that way. And even now you see wage growth moderating, and I also look at short-run inflation expectations. Short-run inflation expectations are coming down. As they come down, research out of the San Francisco Fed has shown, and others have confirmed this, that short-run inflation expectations are what people are using when they go in to negotiate wages. And so as those come down, you get release of wage pressure. So the worries about wage price spiral, you know, people were worried about it in 22, and we took that very seriously. We asked how that was going. At this point, those have really abated, and now we're really at a point about getting the wage growth rate to be balanced in the economy, bringing the labor market into balance, adding you need about 100,000 jobs per month to keep pace with the labor force growth. At the last call, we were at 150, so tomorrow's labor market report will tell us whether we've made more progress on that space or just sort of in that same place we've been in. But that's how it's different. They're completely different. One keeps me up at night. One is just a natural part of an economy.
So I love that when we were speaking ahead of this, we were talking about anecdotal data, and I said, I love that you study the sociology of markets, and anecdotes are really important. As you said, I don't view them as anecdotes. They're qualitative data.
I think I said it that way.
You did, and you corrected me. You said, absolutely not. I wouldn't call it anecdotes. It is qualitative data. What is the qualitative data or the anecdotes that the conversations you're having?
Here's why I don't call them anecdotes, because anecdotes are like I talked to Bob in the grocery store. and then now I know everything. And that's what, people trade anecdotes all the time because they heard one person, two people, four people at a party say it. At the Fed, the regional Fed presidents in particular, I think it's one of the big benefits of having a regional Fed. When the folks who set this up set it up, I think they thought this would happen, and it does happen, is the regional Fed presidents and the entire regional Fed teams, we're in our districts collecting qualitative information by talking to many people like you, having roundtables, et cetera, but then we write it up. And so the difference in an anecdote and qualitative information is we quantify the qualitative information. If one person says it, it does not mean it's the thing we should take on as fact, but if 50 people say the same thing, well, that's an early warning sign, or some flavor that helps us, flesh out what the aggregate data are telling us. And what the qualitative data are telling me are really, there's many things, but I'll tell you a few. So at the beginning of this year, I'd say most of my conversations, when I asked them, what's your biggest concern? They said recession. Then it switched to stagflation. They thought we were going to have high inflation forever, just low growth like we did before the pandemic. And now now I say, what's your biggest worry? And this is really remarkable. They said, well, I'm really worried about generative AI and how it changes my business in 10 years. I'm really worried we're not educating our population enough to keep pace with the jobs we are creating. So why am I focusing on those? Because those are longer-term concerns, which means the anxiety they have about their short-term business has gone down and is being replaced with the things that really should keep business leaders up at night, right? How is this going to transform my business? Do I have the workforce I need, not today, but 5 years from now, 10 years from now? What do I need to do in my communities to ensure that we're durable? So that has been a sea change. And then when you drill down, like with commercial real estate leaders, of course, they're thinking hard about, okay, I've got this property, what's the future? But their attitude, it was really interesting, across the board, it doesn't matter what position they're holding, is they say there are going to be losses, but there are going to be opportunities. And what I'm trying to do in my business when I went around to each of them is say, I'm trying to minimize the losses and maximize my ability to see and take the opportunities. And so I see that as a positive change in the environment we're in, and it's why I said in the speech that the recession fears are being replaced by soft landing. Soft landing is, just in their description, something that happens that doesn't break the economy and bring all their attention to how do I manage through a significant downturn. And I am not seeing that when I take the temperature on that. I'm seeing instead they're talking about these longer term issues that they're grappling with.
Does that mean that they're hoarding labor? Reluctant to cut jobs because they do have this expectation that even if there is some sort of slowdown, there is going to be a brighter future ahead with not as many qualified employees available to do the jobs that need to get done.
So I have the benefit of having done this work for a while. I was at the Fed long before I became the president, and I've been a labor economist my whole career. So I would like to broaden that part out just a tad. So it is very common when employers go through big shocks that carries over into their behavior. So let's go to the fact that in the financial crisis, employers had to cut nominal wages. They hate cutting nominal wages. Because it demoralizes employees, et cetera. So that had a long tail. They had to fire a lot of workers, right? They had to let go. And for a lot of employers, if you're not the very largest employers in our country, you're letting go of people you know, each and every member of your team, and you had to let those workers go. And then you had to cut nominal wages. It's extremely painful. So then they hired extraordinarily slowly and kept working people overtime and other things just so they didn't have to be in a situation where they would have to let go of workers should another shock come. So now what I'm seeing is the opposite of this. In the pandemic, people lost workers because they were afraid to come to work, or they decided to take early retirement, or they moved away. And so now employers are like, oh gosh, I better keep people. So I think we have to put certain amount of this behavior we're seeing to that. But the other part is, and this is another benefit of doing this for a while, I think, is another part is that the way it works in most cycles is that the very first thing that happens is hiring slows. The second thing that happens is layoffs occur. you don't have a lot of firms laying people off before they slowed their hiring. So when I'm looking at metrics for what I think is happening to the labor market, I'm looking at hiring statistics, job filling rates. You might have postings out there, but you're not filling. And what I'm seeing is a general slowdown, but not a cliff. But obviously, if there was a significant downturn, then businesses have to resize. But we're not seeing that yet. Even the layoffs we've seen have come in the tech sector, where they got a little bit ahead of themselves on growth and then had to rebalance their workforce to meet the actual growth they were going to have. So I don't see anything out there that is ringing an alarm bell about the workforce. And people say labor hoarding. I kind of think of it as we're just always fighting the last war. And you fight the last war of, we had to lay off a lot of people, you don't want anybody new. You fight the last war of, oh my gosh, I lost a lot of people, you hang on tight. We're also in a very tight labor market from the employer's perspective. It's loosening, but from an employer's perspective, they still have to spend a lot of their time finding workers to replace workers who leave, or if they want to open a new slot. That's expensive, so they definitely want to hang on to as many people as possible.
I have to open it up to questions in a second, but I do want to just ask you this before I do that. What do you think right now is the biggest misconception?
We're going to leave Lisa Abramowitz there with San Francisco Fed President Mary Daly talking about the job cuts in the tech sector, talking about the implications of generative AI, talking about some of the labor relationships that we've seen overall in Hollywood. Much more on LiveGo if you want to keep on listening in to that macro perspective. But stay with us on Bloomberg Technology. We'll be back with much more to do with the labor market and women within it. This is Bloomberg Technology. So we've just been hearing from Mary Daly about the labor market. Let's talk about women's presence within it, because Chief, it's the private membership network designed to connect and support women executive leaders. It's hosting Chief X, first conference in Palm Springs, bringing hundreds of members together in person, thousands virtually. We want to check in on really what's being said by some of the key speakers they've had across the tech world. They've had, of course, the CEO of Slack there, for example. We welcome Chief CEO and co-founder Caroline Hyde now from, I'm pretty sure, always great to be in person. What is the atmosphere like? How much resilience and optimism is there among women in executive roles right now?
Yeah, well, thanks for having us. It's really exciting to join from Chief X, our first ever conference for Chief here in Palm Springs. And the energy has just been really magical. So Chief is the most powerful network of senior executive women, and we really built Chief under the mission of changing the face of leadership. And we do that by building a great community that can come together and support each other and build the connections that are needed to really tackle the loneliness and challenges that can come with senior executive leadership. And it's been really exciting to have a new experience of Chief X, of being able to bring women from all over the US and UK here in Palm Springs to be able to really deepen those relationships and have even more inspirational conversations.
Give us the context, the backdrop, though, with which some of these executives find themselves. Because, look, we are seeing actually record participation rate of women in the labor force, but then there's nuance to it. And there's been studies, I think, just announced in the last day or so, McKinsey, Lean In, and Foundation, of course, Sheryl Sandberg's, looking at how perhaps women aren't managing to break into managerial roles. We're actually seeing more executive levels, C-suite, but not at the lower sort of funneling points. How are you talking about that?
Yeah, so, I mean, Chief is focused on senior executive women. Over 40% of our membership are actually C-suite. And that's where you're actually starting to see some shifts. So we've moved from 25% to 28% of C-suite positions being held by women. But importantly, even within C-suite, women of color are only 6%, and we have not seen any changes in those numbers. And then, as I think you were pointing to, there's still very much this broken rung. So even as we're starting to see some progress in the C-suite, that advancement is going to be really challenged when we're still seeing a lack of progress in that middle management level. And that's where, even though you also see that ambition is so much greater, women are more interested in participating in the workplace. People have greater ambition of wanting to go up the corporate ladder. One of the things that is really highly pointed to is flexibility being such a key part of allowing for that ambition to become reality.
And what about in the
I think
tech
what
sector?
we are really facing right now is companies that are pulling people back into the workplace and removing some of that flexibility, and that's going to be a real challenge for us to continue to push these numbers.
Yeah, Caroline, dwell in on that, because you're a leader in the tech sector. How much are you seeing a lack of flexibility or more in the sector than which we work?
Yeah, I mean, I think that you are seeing that a lot of companies are starting to pull back on those policies. And I think some of that has to do with both the economy in a way of somewhat reducing their workforce by saying, like, some people will opt out of that, and that will actually help them as they go through workplace reductions. But I think what that people aren't keeping in mind is that the people who need the flexibility the most are women and underrepresented minorities. Those are the people who have found the most benefit from the flexibility that has come into the workplace over the last several years. So all of these companies who have also had these commitments to DEI, that's really going to challenge them as they really pull back on the flexibility in the workplace.
Important message. And it's interesting how some of this focus on DEI moves with, well, the economic realities with which we face as well. I'm interested in your own realities because, I mean, Chief is a unicorn from last time we counted. And you were raising money March 2022. You raised $100 million. You were $1.1 billion valuation. Is that still standing? And how is your business growing?
Yeah, well, we are 20,000 members strong at Chief. It has been just phenomenal to see that growth over the last several years. But there's still 5 million women in the US alone who are VP level and above. So the opportunities for Chief to become an even more powerful community, a powerful network, to really be able to create the support and the change that is needed to change the face of leadership, there's still so much opportunity for us. And while I think there is this pressure across the ecosystem where companies are pulling back on their commitments to DEI and they are pulling back on their commitments to ESG, what is needed more than ever are good leaders, regardless of gender, regardless of race. And there's still an investment that needs to be had there, and there's still a place for Chief to play that role. While also really continuing to push companies who, you know, they made the commitments when it was easy. And how do you make sure that people are really still holding to those statements and the importance and the benefits that we all have grown to recognize exist for companies who have great diversity in their workforce?
Caroline Childers, Chief CEO, co-founder, we thank you for your time. That does it for this edition of Bloomberg Technology. Check out our podcast when you got the moment. This is Bloomberg.